Good morning, everybody. Welcome to the Flow Show, day before Fed Day. Everyone's just still running around trying to find out what they're going to do, how they're going to cut it, what the Fed's going to do. And we're playing that game for the next couple of days, I should think. Morning, Kate. How you doing, sir?
Morning, Ryan. Good morning, everybody. Yeah, I'm doing all right, mate. Ready to start the engines for the week for good. Yeah, we're kicking off today, right? So, yeah, tomorrow big event, but today we are already looking out to a few things that may shake a little bit the tree.
Yep, definitely. And we'll go over what's coming up today to see if there are any trees to be shaken. How things change in Japan. Finance Minister Suzuki says recent FX fluctuations have both merits and demerits on the economy. They said they will respond appropriately after analysing the impact of Forex moves. Rapid FX moves are undesirable. It's important for currencies to move in a stable manner, reflecting fundamentals. So same rhetoric as we see yen gaining, as we did when we saw it weaken. Kate, we're going to get intervention on this side?
No, not yet. If we produce another 20 big figures like we have done in a month's time, perhaps they might be tempted to buy back a little bit of what they sold, take the profit, and tell investors how to do it. Or speculators rather. No, we are not going there right now. I think it's a gentle message to Ueda to not step too hard on the tightening pedal. Just a little bit of a warning. And no. Of course, we can never say never if it gets too violent, as I say, but because they're always stand ready to smoothen the market, because if everybody wants from central banks to Ministry of Finances, the only thing they really want is our smooth markets. And as I said, I mean, it's going to take a lot for them to step in. And if you want me to stick a price on it, it won't be before 110 or even 100, buying dollar yen. This is not at the order of the day, I think.
Yeah, no, I agree with that. Obviously, that was a bit of a tongue-in-cheek question. But it still is important, the volatility for them, both sides, whether yen weakening or strengthening, because it upset, you upset either the importers or you upset the exporters. There's always one side who doesn't like currency moves, so it is a big part of their thing. So we shouldn't be too surprised if they come out with comments like that. Moving over to the ECB bods, ECB's Kazakhs says interest rates will continue to be lowered. There is no big reason to disagree with rate bets for next year. ECB Simca says the likelihood of an October rate cut is very small. We don't have many new data points in October. The economy is developing in line with forecasts, and it's questionable whether an October cut is needed. So that's following the path that if they're going to move on forecast meetings. ECB's Lane got his wages report out again. He does like write a report on wages. It says incoming data on wages and profits have been in line with expectations. Negotiated wage growth will remain high and volatile over the remainder of the year. A gradual approach to dialing back restrictiveness will be appropriate if the incoming data are in line with the baseline projections. We will act meeting by meeting, guided by the data. That bumpiness or that volatility in wages was evident in Spain today. Their Q2 labour costs rose to 4.1% from 3.9% quarter on quarter. We also got some zoo data out as well this morning, which was a lot of fun and games. That came in even worse than expected. Was expected to get worse, to minus 80 for minus 77.3, came in at minus 84.5, and expectations came in at 3.6 versus 17.1 expected. So real falling out of bed those German numbers still no let up for the bad news over there. Coming over to the US, yesterday we got Empire State numbers, which showed a really decent bounce. Was expected to come in just a little bit less crappy, and in fact it came in plus 11.50. This number has been a bit volatile of late. If we just go and look at the chart, it has been more negative than positive. Don't know why it's not showing yesterday's number, but anyway, you can see it's been a bit up and down, but more down than up of late. In the subcomponents, new orders rose to plus 9.4 from minus 7.9 previously. Prices paid came down a bit though to 7.4 from 8.5. Employment was a little bit less negative at minus 5.7 versus minus 6.7 prior. Probably all the improvement was on expectations, 6-month expectations rising to 30.6 from 22.9 previously. So small manufacturing number, but it's the first of the new month. We'll see if the rest follows suit. We get Philly Fed, I think, Wednesday or Thursday. So we'll wait and see what that number brings as well. Over in Canada, some manufacturing sales data out there was a decent beat as well, up 1.4% month on month, doubling what was expected. Right, we're still playing the 50-25 Fed cut game. Yesterday, the SOFRs, as we like to call them, the secured overnight financing rate, now priced a 50 basis point cut at 60%. So we're getting an increase there, but these metrics are a little bit all over the place at the moment, though it does seem that 50s is gaining in positivity. If I just show you the CME Fed numbers, pricing probability 67%. So again, this is important just to know where the market is going in. Now it could all change come tomorrow evening. We could get some data out that swings this the other way around. So it's not a done deal here, but just keep an eye on this sort of thing just before the Fed tomorrow, because whatever side this is leaning, that's roughly where the market's going to be leaning going in. You know what the risk is if the decision comes in differently to that. But anyway, we are edging towards this 50 BP mark. K, it's really making this Fed, a big one, then it's making it a bit binary, because usually we have the market settles into one or the other. So, but we're still swinging.
This is the call for the 50. This is really telling the Fed you should do 50. There's nothing more to really say about it. The market is really gearing up towards a 50. I mean, this is now putting the 25 BPs into shock territory. Even if Powell would hint and leave the door open to 50 later, which is extremely possible, if they would do 25 now, that's going to see a bit of a repricing going on, at least for the next weeks. Dare I say, if it does give the market 50 though, then that's going to probably set the tone equally to the other side for the dollar potentially into year end. It's a big meeting. It's usually it's done by the press, and the market goes a little bit from one side to the other, but now it's really pushing for the Fed to do 50. And so yeah, that's the big surprise is now doing only 25, and it perhaps pushes the what comes next a bit to the back end of the cube. But still, it's going to be big, of course, to know what the potential path will be. The dots, the unemployment rate expectations, as I already said, are going to be pretty important as well, because they are in a still keeping a quite tight range in the last projections. Yeah, it's all gearing up to be a very big meeting tomorrow.
Yeah, and I think it's important to note too, traders, any inexperienced traders watching as well, the market expectations for this one going in is going to have a different reaction to other central banks. Take the ECB last week. The market was expecting 25 pip cut. It got a 25 pip cut. As we saw, nothing happened in euro. It was a boring one. If the market is expecting 50 basis points from the Fed going in to tomorrow, and it gets 50 basis points, you're not going to see a boring reaction, because the nature of it is that the Fed have gone their first cut, a big one, a 50. Okay, that's going to get the market thinking, well, shit, what's happening if they've actually gone a 50? Is there something they know that we don't, something bad? So it's, although you need to know what the market is expecting, you have to still know how the market's going to react if it gets that expectation. The ECB, nothing. The Fed, it's going to be something. So whether they go 25, whether they go 50, the market is likely to see a big move on it, because it raises, each 25 or each scenario raises different questions that the market will want answered. So don't think if we get a 50 tomorrow, the market's going to go, yeah, nothing doing, and move on with its life. That's not the case. You need to know the context of these meetings and these rate cuts that are potentially coming. In the meanwhile, we've had Powell's arch nemesis, Liz Warren, among 3 politicians who wrote to the Fed asking for a 75 pip cut to be given tomorrow. Those that don't know, Liz Warren absolutely despises Powell, always has done, always will do. And she is never short of airing her opinion to that effect, or doing things like this, writing letters to the Fed. Ignore it for what it is. There's no way the Fed's going to listen to her or even do a 75 pip cut. So just forget about that. But this is the state that politicians are. And as I mentioned after the German data this morning, you'd have a reason to think why maybe German politicians would write to the ECB asking for a 75 pip cut after that data. But things in America are different, of course. Citigroup have weighed in on the US election, saying that both candidates are negative for stocks. They say if Harris comes in, then the fair value for stocks is some 4 to 6% lower. For Trump, it's 0 to -4% for stocks if he wins. So in either scenario, the fair value of stocks likely lower. JP Morgan, they're not bullish on stocks either. They say don't expect much from stocks for the next decade. Over in the UK, PM Starmer says that, or he insists that the budget will not contain measures that stifle growth. They seem to be doing that already without the budget, trying to stifle growth. But he's trying to ease the market into that budget at the end of October. And in Canada, Trudeau's ruling party has lost a key seat in Quebec. So it's another kick in the nuts for him and his party and his leadership of the country. So it could be that we're heading to a sooner election over there than he hopes, the next one due next autumn. But the pressure is mounting for one to come sooner than that. Just what we need, more elections. Right, just looking at the data that's coming today that we've got. Obviously, retail sales is going to be the top number to look at, just for what it means for last minute jumping around going into the Fed. We are expecting a little dip, -0.2 in the headline number from the gain of 1% that we saw last month. The control group, this is, I know there's a core sales number, but the control group is seen as more of the core number. That was 0.3% prior. Let me see if I've got a up-to-date expectations on here. No, can't find it. Oh, yes, we do. So expect to come in unchanged, 0.3% for that control group. And whatever this core number is, expected to come in a little bit softer than last month. So this one is really going to be, is it a massive stinker or is it a massive beat? Anywhere in between, probably not going to do an awful lot surrounding that number. But given the heightened focus on this 25, 50 pip rate thing, any number might get that moving again. And then we've got Canadian CPI, which we know the BOC is in its cut cycle, happy to keep going. So this might be data that might not matter either way. But again, look for a big variation. If we're, over 3 pips higher, lower either side, it's probably going to bring a bigger reaction. Certainly getting all these numbers with a one handle on, that will get the market probably dialing up expectations for, well, certainly for the Bank of Canada to continue, but maybe we start playing a 50 pip cut game over there as well. Kay, your thoughts on both sets of data for their respective central banks?
Well, the biggest reaction will probably be again on a bad number in either of them, or I mean low number. It's not necessarily bad when CPI comes down, but on a low print. Because for the Canadian CPI, McClem has already said that he's ready to go in bigger if needed. So the market will be looking for a weaker print to really weigh on the Canadian dollar. We've been like, Canadian dollar is weaker versus on the cross side, but we've been very stable in the dollar CAD, which is also reflecting CAD weakness because the dollar is weaker everywhere else. And then, the retail sales, as you say, like look at the variation. Control group is expected. I saw some expectations to tick a slight bit lower. So that if it confirms, that won't change too much for tomorrow, but it's going to have to be a big beat for any of the expectations to change, because we know that the consumer is an important part of the Fed's thinking around rate support for the economy. So if the consumer holds up well, that might just keep them for this time on the 25 BPs, but I don't think it's going to change too much for particularly tomorrow's thinking by the Fed. IP could be another one a bit later that is giving a little bit of an extra to what the market is thinking. But I don't think that unless big variations, that we are going to see a lot of change in the market's thinking right now.
Yeah, and I want to make you guys and girls aware of something, okay? And this is something we've spoken about previously, certainly when inflation was coming down. The next problem that central banks are going to face is whether inflation starts going below their targets. When inflation's saying at 6, 7, 5% or whatever, they want to get it to target. Their big risk now, their biggest fear now, is that it goes through target. If the market starts seeing that, then they're going to be screaming for rate cuts back to 0 or something stupid like that. So we're going to get an extreme move in market activity and pricing and extremism again if CPIs around the globe start going through the 2% handle into the 1%. And if it gets to the low 1%, then the markets really will start kicking and screaming. But that's the next worry, for probably the current worry for a lot of central banks right now. So that'll be the next game we play, particularly once the Fed get on their cycle. That may be something that puts them towards a 50, that the rate of inflation coming down picks up and they want to try and get ahead of that. But there's reasons why they might go 50. There's reasons why they shouldn't go 50 or should go 25, and they're probably equally balanced. And who knows what they're going to do tomorrow? But that's something just to keep an eye on. Most central banks have a 2% target. The BOC, for example, have 2%, but in a 1 to 3% range. So they allow it to roam a bit. The ECB, their actual mandate is for inflation to be close to but below 2%. Long story short, no central bank is able to control inflation and keep it steady at one level. Got more chance of controlling the tides in the sea than they have inflation. So that's what we got coming up later. Anyway, we also got industrial production from the US. Again, just keep an eye on that one. If there's a big variation in the data, it will lead to, again, market moving around those expectations. 20-year auction later as well, Kay. Do we need to keep an eye on that one, or is the market not going to care?
We know how the market is thinking right now. I think I'll go blip around the result and then focusing back on what's happening tomorrow. What I apparently Rogers is speaking later today as well, so that's after the CPI. I'd say watch that as well for the Canadian dollar, because she has been more on the hawkish side compared to stiffers, right? So depending on how that CPI prints a bit later, she could, if it's a bit of a stickier print, she could undo a bit of the dovishness that McClem has been coming up with. So I wouldn't completely dismiss her intervention later today. It's going to be pretty late for us. Yeah, that is one that to keep a half an eye on, I think. And then tomorrow morning before our next flow show, we will have our UK data, Ryan.
Yeah, the old CPI coming in tomorrow.
The old CPI tomorrow.
The old CPI. Let's have a look at that. See what's coming up, just to show you boys and girls what's coming up and what's expected. So CPI, headline CPI, expected to come in unchanged 2.2. The core is actually expected to go up 2 pips to 3.5%. Now, if those numbers are confirmed, you're going to probably see even less expectation for a rate cut tomorrow. But if there is a bit of a surprise, and again, look at this number for the 2 handle. If it gets a 1 handle on it, that will probably increase expectation for a cut this week, even if it's a modest increase from whatever it is now, 20% to 30% or something like that. That still might be enough to move the quid somewhat. PPI data as well, that's obviously can be a more volatile number, but just keep an eye on that one as well. For the quid, it's again, I think like you say, Kate, it's probably just an algo move on this one, unless there's a huge change in the numbers.
Well, okay, I know that all bar one, I think, so economists view the Bank of England as a non-event this time. I personally put the risk of a cut higher, especially, and I know central banks are all independent, but the independence goes only that far. And I think if the Fed comes up with a 50 tomorrow, and no, 2 conditions. CPI comes in lower tomorrow, and the Fed goes 50 tomorrow. I think we may have a surprise 25 BP cut by the Bank of England the day after. But it's just my personal view, and because I think the chances are higher than what the market thinks really. We did have flat growth for the 2nd month in a row. Huh?
Yeah, we did.
And that's what pushing me to think that the possibility is not virtually zero, like some in the market may say.
Yeah, no, I might agree with that. Base cases they don't go. I think it's a pretty low risk that they do go something. I think they will have one eye on the budget as well, even though monetary policy and what's going on in inflation will have no bearing, or the budget will have no bearing on that per se. They still like to know what's going to be coming from it. That may stay their hand a little bit. But you never know with these clowns. The vote's going to be important. I mean, we'll get stuck into it in more detail tomorrow and Thursday. But yeah, I think it's a pretty low chance we get a cut from those. But as we always say in markets, you never say never. Right, so we might as well start with the quid. Sorry, mate, unless you've got any other headlines you want to bring us?
No. Go ahead.
Cool. Right, we'll start with the quid and then good old cable. Let's just come bring it in a bit. We're seeing pretty similar patterns in a lot of assets that have come off tops. You know, euro dollar at 112, cable off of this high here. We had a bit of a downtrend over the last few weeks. That's coming or getting washed out at the moment. I don't think this is because everyone's piling into pound longs. I think it's a bit of just a maybe some squaring up, maybe a tiny bit of positioning over this 50 pip cut crap from the Fed. But for me, this more looks like, just as I say, a bit of risk reduction. If you've been short in this, you don't want to be short down here running into a confirmed 50 basis point cut from the Fed. So, you know, I think we're going to be seeing that in a lot of assets. How high it wants to go, who knows? If it does go on to break through the high, then we're probably more so trading the 50 than risk reduction. But as I said, euro dollar looking very similar as well, just moving up to this next resistance area, breaking this downtrend, but I'm not going to trust it this close to the Fed, of course. Kay, what's your thoughts on this? We get to that point where these sort of moves can suck in traders thinking, oh, yes, the pound euro's bullish, when really it's just people getting out of shorter term positions with a risk event. Can leave a bit of a liquidity black hole.
I think if you look at the European side of things, there's no reason for it to go up. So it's all about the dollar. And the dollar, obviously, being the biggest market, has the potential to drag everything around. So it's all going to be how the market reacts tomorrow. For me, this is enough here. I'm even tempted to start shorting some euro crosses again somewhere, but there's still so much uncertainty. And what are you going to do with the euro sterling, for instance? Imagine that Bank of England does surprise. But if they don't, I think this one is a candidate for breaking lower. Right? I know that you are thinking, because of the level is so big, that we may be in a bottom forming formation, which is possible. But I do think that if we don't see this lower CPI tomorrow, and if the Bank of England holds still, there is, for me, a potential for going lower in this one. This would be a cross of choice. Another one, thinking about the euro, if you want to take the dollar away, maybe euros against commodity currencies, something like the euro Aussie or so. But there as well, we have an important report coming up on Thursday, a very early morning our time, with the Aussie employment report. So there's risk in everything we take on right now. But to me, really, euro, I'm still not a big believer in euro as such right now.
Yeah, I mean, it really is a bit of a washing machine at the moment in terms of the dollar. I mean, just to have a quick flick around, you've got dollar China, you know, still looking a bit weak. You've got dollar yen looking a bit stronger. You know, when that goes up, you usually expect the likes of euro dollar and cable to be going down, but it's not. You've got dollar CAD doing absolutely nothing in the middle. Aussie dollar, similar theme to cable and the euro. So there's no real rhyme or reason, because you think the dollar's weakening in some places and it's strengthening in others, and then you think, well, let's have a look at yields and see what they're doing to maybe get an idea. At the moment, yields look absolutely stuck down there at their lows. So, you know, what's going on with the dollar? If yields aren't moving, why is the dollar moving? But that's why we're seeing the dollar moving all over the place. So when you can't, I always like to know what's driving what. Is the yen driving something? Is the pound driving something? Is the dollar driving something? Is yields driving something? Right now, as I say, it's just a bit washing machine. There's no real drivers going on, and that again tells me this is just the market taking its foot off the pedals, waiting for the Fed before it then jumps back in and starts making some moves, and we really start to see some things. So guess what I'm saying is, don't get sucked into any moves you see right now. You know, the euro may be looking stronger, but one bit of data or the Fed tomorrow, we could be through 112 as easy as we could be trading under 110. It's that simple. So I have no conviction for any of these moves at the moment, and that's the way I'm going to be protecting my account. I'm not looking to get in. I'm still long some euro dollar from down here, but I've got enough margin to play within it, so I don't need to panic about it. And we'll see what it wants to do afterwards. Yeah, going back to euro sterling. I mean, this, we've been joking about this flag pattern, which is wilting now at the moment. I am interested in trying this, but I want to see how it reacts. I don't have to try it before the data. I still think there's two-way risk for this one, both from the BOE and what they do and what the Fed does purely on the volatility difference between cable and the euro dollar. So it could be that we do go under 84, maybe even through 83.80 over these recent events. But if that happens, I'm going to see where we are after we're past these events. So if we come through the BOE Friday and we're below 84 and it's resisting, then I might think about the short side. If we've been under it over the BOE, but Friday I come in and we're, you know, 84, 5, 10 and holding the figure, then I might think, okay, we've had the algo blip or the news blip and now the market's back above and now I'll get into longs then. So I don't need to rush into a trade. You don't need to rush into a trade at the moment. Pick your places, pick your levels, and assess the news. Kay, do you want to take it for a few? Because I've got little inspiration at the moment, I can tell you.
Yeah, sure. Yep. Okay, let me just grab it here. Yeah, there. We're a little bit ahead of levels here in gold, but it's I think it's kind of logic. And I think we're not too far away. If you take the width of these, like $60, you break $60. That's it. You know, we're actually just added on the width of this range to on top when it broke. What am I doing here? And that's where we are stalling now. So this is interesting. This is potentially a bit of a level building up here around 25.90. We're coming back a little, as I said. We need what we need to know now going into the Fed is whether one of these levels is already showing up. 25.65, 25.5. Those are my first levels that I'm watching. And obviously, on top side, the prior high, it may have to wait. I really think it will wait for what's happening next. I'm not sure that the retail sale today could cause a big move. It could just move up there, but it looks as if the market wants to take a bit of profit right here and now, and that's very reasonable going into the big decision that will have to be made tomorrow. And so this is a bit logic, and I'd say watch those two levels below here. Obviously, this one here, the 25.30, is going to be a big one below there. But I would say that this would not be challenged before we get into the FOMC tomorrow. Silver as well. I took some off yesterday because we're coming into the next little. If you take, not sure if we need to keep that line in here. If we take the next levels here into account, just above 31, we stopped there. And in sympathy as well with what's happening in gold, I think those two march together at different speeds. But there's also room and space and good enough reason to take a few off. And perhaps we can even get back to this lower zone here when this break zone just above 30 before we move into the FOMC. I'd say you've got about a buck here to play with. We know that silver can be a bit than um, more volatile than gold. So allow for those kind of moves. Okay, I've taken some off into 30 into 31 of what I've have running. Same in gold, by the way. I've taken some off as well in the 80s. Always remain reasonable and leave room into the account to do the next trade. Okay. Interesting one, of course, and that's going to be a big one tomorrow. But now that we are like ahead of this of the CPI as well, already 132 figure-ish, 132 figure 10. It could be look if we get back under there, could be looking a little bit failure-ish, and that's perhaps something that we need to look out for on tomorrow's CPI. Okay, in the cable in preparation of if we see some adjustments of positions. I wouldn't be surprised if we get this little blip lower here in the cable over the course of the day, just into the CPI. All right, but if this CPI is sticky, I think cable is going to be one big candidate to continue to fly if Powell gives us 50. But that's music for tomorrow. We've seen the euro sterling already. Aussie, yeah. I think Aussies put in a really decent break here, and we are holding all those breaks. This is not going to need too much to go and test this 68 figure a quarter. Again, we're ahead of the FOMC, and then ahead of that Aussie employment but of course the FOMC will be bigger tomorrow. But on the day, it still looks very constructive. If we get back down to levels just below 67.5, see if we already get some support there perhaps. But this Aussie looks really still quite good to me, and I'm going to be a very close watcher of what's happening if ever we get back into the low 67s, because it could be a bit of a retracement and then start to go again. So this is one that I'm keeping a very close eye on. I don't have anything running anymore, but I'm going to keep a very close eye on this. Okay. What else? It's a bit early. Is it tomorrow or the day after Norges Bank? No, I'll look at the Norwegian kroner tomorrow. I want to look at a few of those cat crosses going into the CPI this afternoon. First of all, sterling cat. We are turning, and we are actually, because this is a daily, we are actually trying to break here a bit of an extension. And you can see from prior market moves that somewhere around 179, 180, it's always had some activity on the sterling cat. Okay, get a weaker CPI this afternoon on the Canadian. This is one that could really reach for the skies if tomorrow UK CPI doesn't disappoint. If in turn we start to get inverse data, meaning a sticky CPI in Canada and perhaps a weaker one in the UK, this may be in for a little bit of a fake move and come back into this wedge. This is one where I'm going to keep a very close eye on going into this afternoon and then tomorrow early doors on the UK inflation data. Yeah, and another one is this one as well. Aussie Cat is really trying to push for it now. I think that on it is very good, looking very good. Get a little bit of a stickier CPI this afternoon. We may get that 20, 30 pips lower here, but watch out what's happening in 91.5 area on the Aussie Cat. If it holds, this could be a bit of a springboard to finally go back up to that higher level. This is how I look for the moment. If you want to steer away from the dollar going into the FOMC, keep an eye on those crosses. You know, they do give interesting ways to play currencies without necessarily having to think about, what's going to happen over the FOMC. No, you can trade those crosses, and those are always very, very interesting, and I'm always keeping a very close eye on what is happening there. And the rest, really, I'm going to talk about it tomorrow. Whoops, no, there's one that we need to, and I'm not sure whether Suzuki is any serious about this dollar yen. The one thing though that we also have to keep an eye on, because that is also something that the Ministry of Finance and the government will look at, together with the Bank of Japan. A stronger currency is deflationary. Okay, we know that there are we need several percentage of moves in a currency before it impacts the inflation. Okay, but I guess one of the reasons why Suzuki was talking about this move, well, first of all, it was a pretty violent move. This is a weekly, by the way. Okay, so it's quite a longer term. So it happened over 2 months' time. Yeah, but the if we would see on the FOMC another big drop lower, I think we are going to start to hear more of those comments, because they want to beat deflation. But if your currency strengthens, it is deflationary. So if you want to keep the inflation going, they somewhere will not want, and I'm using the dollar yen, but you can use other yen pairs as well. You can use the futures on the yen, for instance. You don't want your yen to strengthen too much either. All right. So I think if we get another abrupt move lower in dollar yen, we are going to see more comments like we heard now from Suzuki, just because they will be scared that inflation is going to come down too rapidly, and Bank of Japan being stuck. All right. Okay, so that's what I just wanted to say. For me, right now, it's still that bottom end here, 138 or 139 and a quarter, depending where you put that starting point. Remember, and the top end of the cloud, which is around just below, actually, around 140, 130, just below this little line that showed up, those levels that showed up in the mid 140s. And with that, Ryan, back over to you for today.
Thanks very much, mate. Just going to answer Ali's question, talking about his win-loss ratio. If I understand this correctly, you've got a 50-50 ratio, but it looks like 50% is more break-even and the other 50% is losses, it's difficult. Having that break-even is better than having 75, 100% losses, of course. But what you've got to do now is, this is why we're constantly going about pushing your winning trades. You've got to maximize the winners. You can have a 50-50 win-loss ratio. You can have a 45% win ratio and a 55% loss ratio. But if that 45% is making more than the 55% you're losing, then you're going to make money. So it's not just about the win-loss ratio per se. It's about improving your stats within the win-loss ratio. Lose little, make more. That's what you've got to work on. So that's why you don't sit in your losses too long, or you have them controlled. And when you get in a winner, you've got to squeeze out as much as you can. That's what tips you over the edge, okay, into an account that overall is making money, not overall losing money. Okay, so Ali, so it's not just about the win-loss ratio, it's about the percentage within losses and wins as well. Right, on that note, I think we'll call it a day. I was going to show it, but you've all got charts. Keep an eye on the S&P. We're just up tapping the highs that we saw into the end of August. Not quite as high as the all-time high, around the 56, 70s, depending on what contract you're looking in. But we're knocking up against the highs, as I say, that we saw last week of August, coming into early September, around the 56-50s area. So just keep an eye on that. I wouldn't so much trust a break if it's driven by data and whatnot. A bit like the gold move the other week. I wouldn't have liked to break if it had happened over data, because you're higher risk of a fake out. Right. Anyway, we'll call that a day for today. Trade safe. over the data today, and we'll catch up with you tomorrow. Cheers, Kate, as always.